Starbucks is making a bold move that signals a significant shift in the coffee landscape as it closes down hundreds of its locations. Once considered an invincible presence in bustling cities and quaint suburbs alike, the coffee giant is facing a new reality. Imagine comedian Louis Black humorously noting back in 2001 that the end of the universe seemed to be marked by Houston, Texas, where two Starbucks sat across the street from one another. Fast forward to today, and both the coffee culture and Starbucks itself are undergoing drastic changes. The rise of competition, persistently high inflation, and evolving customer preferences are putting pressure on Starbucks' financial performance. Recently, Starbucks made headlines by announcing its decision to shutter 1% of its North American stores this month. This tough choice comes alongside corporate layoffs totaling 900 employees, all part of a $1 billion restructuring initiative aimed at adapting to the new market conditions. According to Starbucks CEO Brian Niccol, the stores being closed either did not align with customer expectations or failed to generate profit. Closing approximately 400 locations may seem minuscule considering Starbucks boasts over 32,000 stores worldwide, with plans to open more in the coming year. However, this downsizing is indicative of deeper issues within the brand. R.J. Hottovy, an analyst with Placer.ai, explained that a key factor in these closures is the shift in consumer behavior following the COVID-19 pandemic. Many patrons have relocated from urban centers to suburban or rural areas, leading Starbucks to cut leases in regions experiencing a significant drop in foot traffic. Additionally, the coffee chain now faces stiff competition not only from independent local coffee shops, but also from expanding chains like Blank Street Coffee and Dutch Bros, which focus heavily on drive-thru service. And there's more. Consumer sentiment is turning against Starbucks due to rising prices. A recent UBS survey of 1,600 consumers revealed that over 70% of respondents cited higher prices as the reason they plan to reduce their visits to Starbucks over the next year. The survey highlighted that this issue resonates particularly with individuals earning less than $100,000 annually. Hottovy pointed out that the company's efforts to rejuvenate its brand are hampered by ongoing economic instability and the rapid proliferation of competitors focused on drive-thru services. Starbucks is not new to challenges. It has endured a series of strategic missteps and a revolving door of leadership changes before Niccol took the reins in September 2024. Since then, the performance of stores that have been open for a year has decreased for 6 consecutive quarters, while the company's stock has fallen by about 9% in 2023. Despite these hurdles, investors and analysts maintain high hopes for Niccol, who previously turned around brands like Chipotle and Taco Bell. Last year, he received nearly $100 million in compensation, a figure that underscores the enormous expectations riding on his shoulders. In a bold bid to reclaim Starbucks' identity as a community gathering space or third place, Niccol is reshaping the brand. He notes that previous strategies leaned too heavily on mobile ordering, which dulled the essential charm of the Starbucks experience. As part of his revitalization efforts, Starbucks has made several notable changes. They've reinstated the tradition of baristas personalizing cups with handwritten notes, reverted to self-service milk and sugar stations, streamlined the menu by cutting 30% of food and drink items, and put an end to the open bathroom policy for non-paying customers. The impact of layoffs also looms large, with 1,300 corporate employees let go in February. Starbucks is aiming to win back customers looking to enjoy their coffee in-store by renovating 1,000 locations, representing 10% of its company-owned U.S. stores, with comfortable seating and functional amenities like power outlets. The goal is to implement changes across all U.S. locations within the next 3 years. However, not all feedback has been positive. Some employees report that new menu items are overly complicated, leading to stress during peak hours, and there have been log jams with doodling cups due to high demand. That said, analysts are optimistic about Starbucks moving forward. Peter Sala, a BTIG analyst, acknowledged that while the recovery might be taking longer than initially anticipated, now expected to stretch into early to mid-2026, there are clear signs of progress stemming from Nichols' initiatives. Once these strategies begin to take effect, we foresee significant positive changes, Sala confidently stated. It's an evolving narrative, and one we'll continue watching. What do you think? Is Starbucks making the right moves to stay relevant in a rapidly changing market, or are they losing their touch? We'd love to hear your thoughts.